Welcome to the Spinoff Investing Simplified Spinoff Basics Investing course, brought to you by spinoffinvestingsimplified.com. Awesome. Well, I feel like I've talked a lot. Did you want to talk about management first?
Sure, yeah. Yeah, so I think the other thing we wanted to cover was just how to evaluate management and specifically as it relates to spinoffs. And, I'm no expert by any means, but I would say I have definitely had a few lessons learned. What I typically am looking for. So generally when you're looking at the management team, unless it's at least it's been my experience, unless it's a, micro cap or a tiny company, you're going to read the resume of the management of the CEO and the CFO, and it's going to look really, really impressive, has done X, Y, Z, graduated from this fancy school, has done this, this, and this. And so it's kind of hard to suss out, what's a good manager, what's not. And I need to do an empirical work to actually figure out if this is the case or not, but it's been my observation that more oftentimes than not, if when you're evaluating a spinoff, if the new management team is coming from the spinoff, so the parent, so say whoever was ran the division before it gets spun off stays on as a CEO once it becomes a new publicly traded company, those companies tend to do well and they tend to have fewer negative operating surprises. And you would think, oftentimes you see parent companies bring in, fancy highfalutin CEOs and CFOs from other companies to run their spinoff. But what I found is that oftentimes the CEO who actually knows the business is better suited to run the business than somebody that's completely brand new. And the reason why that's the case is with spinoffs, it's often a situation where there's a lot of low-hanging fruit. It's usually a division that's been ignored by the parent company. And then there might be some skeletons buried in the closet. So it helps to know where the skeletons are, where the spinoff sensitivities are, and where the low-hanging fruit is. To give you an example, Contour Brand. So that was a recent spinoff from VF Corp. And it's one that has performed well. It's actually absolutely gotten crushed in the past couple of weeks. I still think it looks interesting. But the management team is basically, the majority of them have come from VF Corp. And in fact, the CEO, Scott Baxter, for about 3 or 4 years, he ran the denim division, which is the spinoff now, Contour Brands. Contour Brands is mainly made up of 2 denim brands, the Wrangler and the Lee brands. And so he ran that business, ran it well, it grew while he was overseeing it, and then he got rotated to run some other divisions within VF. And then the other management, everybody in the management team is in VF, and that's good from my perspective for a couple of reasons. First, VF Corp is a stock that's done really well. They do a good job managing the business. So that's point number one. The new management team at Contour Brands has been trained well. But number 2, and most importantly, they know where the low-hanging fruit is, and they know where perhaps the skeletons are buried. To give you an example of low-hanging fruit, if you listen to Contour Brands, their Q3 call was really notable. They talked a lot about all the opportunities that they see in the market. Basically, Contour Brands, the Wrangler and the Lee brands were totally ignored as a part of VF Corp. And it makes sense why they were ignored. They were slower growing, not as exciting as North Face and Timberland and Vans and some of the other faster growing Vans brands for VF. And so, but there was obvious low-hanging fruit that just didn't get addressed. One point that Scott Baxter, the CEO, made was that, hey, we have one of the leading brands, denim brands in China, and Lee, it's a brand that resonates really well with the market, but we haven't launched Wrangler, our other big denim brand. And that seems to me like an absolutely no-brainer. You already have the infrastructure built out. You already have the relationships, the distribution partners, and you have the Wrangler brand, which is probably, a better brand than the Lee brand. And it just wasn't a priority for VF to roll that out in China. There were too many other things to focus on. Another one is Levi's is the other obviously big denim brand, or one of the other big denim brands. They sell, I think, I forget what the numbers are, but it's something like 50 t-shirts for every pair of jeans that they sell, or something kind of crazy like that. Basically, Wrangler and Lee sell like one t-shirt for every 50 jeans that they sell. Levi's has a lot more international sales, whereas Contour Brands is primarily, primarily focused on the United States. So there's just a lot of low-hanging fruit that you would think would be an obvious area of investment that was ignored when this company was a part of the parent company. But it takes a CEO who knows that, who's been part of the parent company, to realize that there are these areas that are like no-brainers to invest in. And then in contrast to that, oftentimes you will see a management team brought in who has quote unquote spin-off experience. Like one example comes to mind, Residio, which is a spin-off from Honeywell. They sell comfort products as well as fire protection products. So think fire alarm systems, and also thermostats and things of that nature. And their CEO, not to pick on him, I'm sure he's a very, very capable guy, but like one of his claim to fame was that he used to work at Hewlett-Packard, and he helped arrange the Hewlett-Packard enterprise spinoff and subsequent merger with DXC, which had done really, really well. And so that was like one thing that was really emphasized as to his qualifications. And while that's all well and good, it's probably more important that you really know the business that you're managing inside and out and know where the opportunities are. And, consistent with the trend of when you bring in an outside management team, oftentimes you have operational hiccups. Residio, it's been a mess. They've had to take down guidance like 3 or 4 times. The stock's performed terribly, and the CFO, basically got fired. The CEO has resigned. They're bringing on a new CEO. So it's kind of the opposite of the Contour brand story. And then another example, there are a bunch of examples like this, like Arlo was another example of they brought in an outsider CEO, and immediately, they had inventory issues in the channel, and, they had to issue guidance that was super disappointing. And, I think an insider might have been better able to manage that transition. Another situation, and it's a stock that we talked about in terms of kind of lessons learned, but Quorum Health was a spinoff from Community Health Systems. And again, it was either the CFO or CEO, I forget who it was, but one of the selling points was, hey, this person's done a spinoff before. They've been involved with a spinoff before. And again, that's great. That doesn't hurt. But at the end of the day, probably more important to have somebody that knows the business inside and out.
Absolutely. I think that kind of goes back to what Warren Buffett looks at when he looks at companies. He says, after I buy it, I'm more focused on their operations than I am whether or not the stock price is doing what I want it to do. So yeah, that's a really good lesson to learn.
Yeah, exactly. Just focus on, you want to know the business inside and out. And obviously you want your management team to know it better than anybody.
Yeah, absolutely.
How about you? What about you? What are you, what are you looking for when you're kind of evaluating a management team?
Well, let me share this with you. So to me, aligned management is where the spinoff opportunity really is. Like you were talking about Contour Brands. I love let's just go back for a second to Joel Greenblatt's spinoff characteristics. He has some characteristics that he identifies in his book, You Can Be a Stock Market Genius, on page 69, where he says, these are the characteristics that I'm looking for. And this is characteristic number 2. He says, the insider participation is one of the key areas to look for when picking and choosing between spinoffs. And for me, the most important area. And that's his emphasis. He actually tells us that that's his most important area. And then when all of the required public documents about the spinoff have been filed, I usually look at this area first. And that's all in the same paragraph, just him identifying what it is. He also, it's kind of funny to reread his stuff sometimes. He says, a Form 10 is about as exciting as Gilligan Island's reruns, you know. So anyway, you can think about how exciting some of this can be. But
Right.
personally, I add a little bit more to it. I like to avoid certain things. I don't like to see activist investors in spinoffs usually, because usually it seems like they protect their investment before they protect the investment of the regular shareholders. That's not always the case, but it seems like it's a mixed bag from some of the research that I've done on spinoffs in general. It seems like a lot of there's statistically insignificant that activist investors actually make a difference for it. Management teams that have had a controlling interest in the company and don't have to answer to shareholders is another one that I worry about, just because I don't necessarily want a management team that runs in there, especially if it was in a situation that you were talking about where they come in, you know, on a white horse type of thing, and they don't really know how the business operates.
Right.
They're not going to listen to anybody, and the shareholders are going to be the ones that will suffer probably. For me, I always like to talk about the fish that gets away, I guess, you know. But Red Violet was one of those companies that I looked at back in March of, actually it was about February or March of 2018. And this was a spinoff from Cogent. And some of the things that happened with this, first and foremost, I looked at it and the management team in their Form 10 identified that their directors had 17.9% interest in the outstanding shares of the spinoff. I also learned from that filing that the management team would leave Cogent and go and run Red Violet. So all of their senior leadership was leaving to go and into this spinoff. The company wasn't earning any income, but the management team had a history at Cogent previously of diluting shares. So I personally looked at that and I was like, ooh, I might want to dabble in it a little bit. And so I bought I think I bought 100 shares at about actually I think I bought it at about $8.50 a share. And I was like, okay, then maybe I'll just see what happens with this, because Joel Greenblatt is telling me I need to focus on this. Well, the rest of the story is this. Right here, $7.48 is kind of where I got rid of it in April of 2019. And since then, it has gone well up beyond what I expected. And my lesson is that I need to pay more attention to those management team incentives. And really, if you look at it, even today, after the fall from the coronavirus scare, they're trading at about $17 a share. And so they have practically doubled in about 18 months. And the management team, the reason why I got out is because I had seen that they'd done so much dilution at Cogent prior, but I didn't pay attention to what they had done at Cogent prior to this, where they had run the stock price up so they could dilute the share so that they could continue to grow. That was my mistake. It's kind of hard sometimes to value a company that is not making money. And I can't guarantee that this is the only way to look at a spinoff, and you have to look at the whole picture. And so I don't know if it got away or not, but it's one of those things that I look back and I'm like, if only type of thing, you know. It's water under the bridge now, but
it's funny. I looked at this one too, and it looked really cheap. So with these ones, you know, with the unprofitable spinoffs, you know, the way that I look at them is on an enterprise to revenue multiple basis, and because obviously it takes into account. You can look at it versus comps, and it doesn't matter if they're profitable right now or not. You know, it's a way to value comparable companies that are unprofitable. And it looked really cheap, to your point. The issue was that you pointed out was there was all this negativity surrounding the management team and how they were self-serving and how they just paid themselves and the diluted shareholders. And that scared me off too. There was also a massive short report on Seeking Alpha that somebody published, and the stock literally cratered like 50 or 60%. It was crazy.
Ugh.
And so it was one of those things where it was kind of on my watch list too. And I was like, it kind of looks interesting, kind of red flag management team. And I kind of wrote it off. But it's so interesting that you bring this up because one other company that I've invested in the past and done really well in, and we've talked about it before, is Liberated Syndication, which is primarily a podcast hosting company. So they bought a website hosting company, so they've diversified a little bit. But the situation there was the management team. So I mean, when I bought it, it was like a 5 million market cap company. It was tiny, but it was trading at 3 times earnings, and it looked to be this incredible, profitable, growing business if it wasn't a fraud. And that was the big if, because the issue was that management had essentially, so the same management team was running this company that had previously made an acquisition in China that ended up being turned out to be a fraud. Literally, the chairman of that company, the chairman of Liberated Syndication, he's probably not the chairman anymore, but I think he's in jail right now. The guy who sold him the business in China, last I heard, and still owns like 10% of the stock, I think. But basically, first of all, they acquired a business that turned out to be basically a complete fraud. And then they basically told shareholders, no, it's all good. Everything's great over there. Meanwhile, they were selling all their shares and they got sued and were found settled, without admitting any guilt, of course, with the SEC, that they basically, did insider selling. And so that was kind of the backdrop that I looked into this company with. And that was the reason why nobody wanted to touch it with a 10-foot pole. But it actually created the opportunity because nobody wanted to look at it. It was, from my perspective, there may be an incompetent management team. They acquired a company that turned out to be a fraud. They're sleazy characters. They sold their stock while telling investors that everything is all well and good. But they themselves didn't commit outright fraud. They weren't cooking the numbers. And meanwhile, like objectively, you can look at Liberated Syndication and the GAAP SEC reported numbers look really good. And meanwhile, you could just Google like what are the best podcast hosting networks, and the far and away favorite, and that's changed a little bit now, but it was Liberated Syndication. So you could independently verify that this was actually a real business. And then in terms of incentives, Greenblatt says follow the incentives. That's my favorite thing. That's what I try to do. What was interesting, and you kind of have to. It's like kind of like a I don't know, Prisoner's Dilemma or Game Theory or some sort of game where basically management had insider sold all their stock before it had tanked, so they owned nothing. But the company was radio silent. But the reason that they said that they wanted to spin off the company was to remove the taint of Fab Universal, which was the previous name of the company, and because they thought the stock was undervalued. So that's what they legit or like straight up said in the it was an S1 filing, not a Form 10. And my thought process was, okay, they don't own any of the stock, but this is a stock that's trading at 3 times earnings, 2 times earnings, growing 20% a year, 40% EBITDA margins. They're going to give themselves a lot of stock, and it's going to turn out to be really, really valuable. And sure enough, they were radio silent for basically 9 months. And then sure enough, huge issuances of shares. And then they started to come out and tell the story a little bit more. And they literally granted themselves like 30% of the stock. So without spending $1, they diluted shareholders by 30%. But the stock's up, 15 times from that, despite the dilution. So it's really interesting. It's like, yeah, it's a management team that you can't trust. Yeah, they're gonna try to dilute them. They're gonna, issue themselves shares, but that actually works out to your advantage because that's going to encourage them to actually get the stock price up. And even with 30% dilution, the stock is, incredibly undervalued. One other thing I just wanted to mention, in terms of incentives, you want to follow the incentives, but it is hard sometimes with the larger cap spinoffs, because all of them, I would say, I always search for what percentage of shares are reserved for executive compensation, and it's always a real large number. So like management team always has the incentive to get the stock price up, and they're all going to get a bunch of shares. But if they already own a bunch of shares, they're going to get, and they're going to get a bunch more shares due to the spinoff. And then again, if you see like something like insider buying, or you can kind of get a theory that, oh, this company's flying a little bit underneath the radar because they want to issue themselves shares before the stock price skyrockets. It's kind of like being, like Buffett says, like an investigative reporter. You have to like dig deep and try to get inside their heads and try to figure out what they're thinking.
Yeah, absolutely. I really appreciate you sharing that story about liberated syndication. That's actually part of the reason why I like investing in spinoffs so much, is because you get some really interesting stories that kind of happen. It just
Totally.
And yes, they happen in other areas, but it seems like they happen a little bit more frequently here, and it's just really, it's kind of fun. It's just interesting to do. So.
Yeah, no, exactly. It's fascinating.
Well, awesome, Rich. Do you have anything else you want to share before we close up?
No, I think that covers it.
Awesome. Well, thank you so much for being here, and I'm going to try this one more time. We'll share the last part of the disclaimer. Maybe we can actually get it to work, and we have some music with our show today. So here we go. As we finish up, we have one final note for you. This video was made for educational purposes only. Any companies mentioned in this presentation were discussed for educational purposes only. Discussing such companies and the specifics about them is for illustrative purposes only and not a solicitation to purchase them. We recommend that you conduct your own research and identify why you might want to own the company yourself before you commit any funds. We also recommend that you seek the services of a financial advisor that has considered your situation as your fiduciary. May your education here grow your knowledge, improve your personal investing performance, and give you the confidence to take control of your future. Thanks.